All right, welcome everyone. As masters in finance students, you know the theories, you know the models. But let's be honest, the biggest challenge isn't the theory. It's actually applying it to our own lives. Today, we're going to talk about how to connect that financial intelligence you have with building a genuinely meaningful life.
So let's start with a really simple thought experiment to make this tangible. I know you can all model inflation in your sleep, but it's one thing to know the principle and another to really feel it. So think about your daily cup of coffee. What do you think its true future cost is?
Well, fast forward 40 years, and at a pretty normal 3% inflation rate, that $5 coffee now costs over 16 bucks. It's a perfect example of how our brains just aren't wired for this. We think in straight lines, but value erodes exponentially.
Now, let's crank that up to a 6% rate, which isn't unheard of. Suddenly, that same cup of coffee costs more than $50. This really shows you the compounding power of inflation and sets up the big problem we all need to solve over the long term.
So here it is. Your biggest financial challenge isn't just about putting money aside. It's about making sure your capital grows faster than this silent force that's constantly eating away at its value. If you just hold cash, you are guaranteed to lose over time.
Okay, so how do we outrun it? Here's our game plan. We're going to start with the cost of waiting, then get into the engine of all this, compounding. We'll see why time is your most important ally. Then we'll cover how to protect everything you build, boil it all down to a simple formula, and finally, connect it to the real goal, living a rich life.
Let's dive right into the single biggest hurdle for most people. Just getting started. When it comes to building wealth, putting things off isn't a neutral decision. It has a very real and often a very steep price tag.
At its heart, what is investing? It's really just a trade-off. It's choosing to delay gratification. You're saying no to something you could have today so you can have way more options, way more wealth in the future. Simple concept, but man, it can be hard to do in practice.
All right, now let's talk about the force that makes that trade-off so incredibly worth it. This is the magic, the engine behind every successful long-term investment strategy. I'm talking about the power of compounding.
You've all seen this formula a million times. You know it inside and out. But let's look at it through a different lens. Everyone obsesses over R, the rate of return. But the real superstar of this equation, the thing that does all the heavy lifting, it's T, time. It's the exponent that turns small, consistent efforts into absolutely massive results.
And a great little mental shortcut for this is the rule of 72. You just divide 72 by the interest rate to see how fast your money doubles. The key insight here isn't the math. It's understanding how a seemingly small difference, like your money doubling in 9 years versus, say, 7 years, creates a giant gap in outcomes over a lifetime. And this leads us perfectly to the next key variable in that wealth equation, time. While everybody out there is chasing a higher rate of return, we're about to see that the amount of time you are in the game is an even more powerful lever for building wealth.
Check this out. It's an amazing comparison. You've got Jim Simons, an absolute genius, who generated an unheard of 66% annual return for decades. By any measure of skill, he's the best. And then you have Warren Buffett with a much lower 21% return. And yet Buffett ended up with a fortune over 4 times larger. How on earth is that possible?
The answer is right here. Buffett's real secret weapon wasn't just that he was a great investor. It was that he's been a great investor since he was a kid. He had a huge head start, which allowed that compounding engine to just run and run for over 75 years. Time was his ultimate unfair advantage.
Let's make this even more real with a classic case study. We've got Mr. Early. He starts investing at age 20, contributes for just 10 years, and then he stops. He doesn't put in another dime. Then there's Mr. Late. He starts at age 30 and invests the exact same amount every month for the next 30 years. Who do you think ends up with more?
And the result is it's a perfect picture of time's incredible leverage. Mr. Early's initial investments, even though he stopped contributing, just kept on working for him. That early capital base compounded its way right past Mr. Late's portfolio, even though Mr. Late invested for 3 times as long.
And here is the real kicker. Look at how much money each of them actually put in. Mr. Late invested $54,000, 3 times more than Mr. Early's $18,000. But because Mr. Early gave his money more time to work, he got a much bigger result with a fraction of the investment. That right there is the true cost of waiting.
So we've talked a lot about offense, how to grow your wealth. But a smart financial plan isn't complete without a really strong defense. So let's talk about building your financial shield to protect you from the unexpected things that can completely derail your progress.
Look, your most valuable asset isn't your stock portfolio. It's your ability to earn an income. It's your human capital. So you protect that with health insurance for catastrophic medical bills, term life insurance to provide a safety net for your family, and disability insurance, just in case you can't work.
Next, you protect your actual stuff. You've got insurance for your car and home, of course. FDIC and SIPC insurance protect your bank and brokerage accounts. And finally, estate planning. Things like a will and a power of attorney, which make sure your assets are handled the way you want them to be.
Okay, so we've covered the offense, we've covered the defense. Now let's zoom out and boil all of this down into a simple, memorable philosophy. Let's talk about the simple algebra of wealth.
I love this 4-part framework from Professor Scott Galloway. It's so good. Focus. Get really good at something valuable. Stoicism. Just live below your means. Time. Let that compounding engine do its job. And diversification. Don't bet the farm on one thing. It's a remarkably solid foundation.
And this brings us to our final, and honestly the most important section. We've talked about all the ways to accumulate money, but what's it all for? Let's talk about what it means to build not just a big bank account, but a truly rich life. At the end of the day, financial intelligence is not the goal. It's the tool. It's the means to an end. That end is security and freedom. The security to take risks and pursue work you care about, and the freedom to design a life that actually has purpose. Money is just the fuel. You all have the technical knowledge from your studies, and now you have a practical blueprint for how to apply it to your own life. The mechanics are simple. The journey, though, is personal. So the real question isn't just about how much wealth you'll accumulate. It's about what you're going to do with the freedom it gives you. What kind of life will you build?